Hey, Tim, how are you?
Good, good. How are you, Ram?
I'm doing well. Thanks for joining us today. I'm really pleased today to be joined by Tim from CVA Funds. So CVA's got a team of analysts on the ground in China. They've also launched an ETF focused on thematic investing opportunities in China. And we're going to unpack that today. Ben was also going to join. He was on the line just a second ago. He's in the Middle East right now. The connection wasn't that great. So we'll speak to Ben another time. I did spend a few hours with Tim prior to this. So I'm really excited about what we're going to unpack. So some headline themes. Broadly, we're going to look at the question of China. Is it FUD or is it opportunity? What are the challenges? And I think a lot of that's been discussed around Evergrande and the housing sector. Where are the opportunities, particularly around the domestic consumption market? When do consumers start spending? How to express that? How to approach that? We're also going to talk about consumer trends in China. China is ahead of the U.S. on e-commerce and cashless society. I saw that myself when I visited in China. We're going to talk about that, fast casual. There are a lot of interesting trends underneath the surface, shopping via TikTok, etc. So we can get into that as well. So stay tuned. Tim, do you want to introduce CVA Funds and yourself?
Yeah, thanks so much, Ram, for having me here. So by quick way of background, CVA Funds is core values alpha funds. So taking a step back, myself and Ben come from more of a traditional venture capital background. So we have historically run and managed venture capital in the past 10, 15 years. Ben is a managing partner. I joined on later, investing both across US and the Chinese ecosystem. We've been in most of the nodal tech leaders from Uber, Palantir, Airbnb, to their equivalents such as Meituan, Didi in China. So in a way, we were also based out in Beijing through COVID and before. So we grew up with the Chinese tech ecosystem. We know it like the back of our palms. And the genesis for looking at public equities was because we felt that ever since COVID, a lot of Western media sentiment, rightfully so with the trade war, etc., became very negative on China. But because we are on the ground here, we have a large team of analysts. We are well plugged into the right networks and understanding both the geopolitical trends as well as technology innovation. We feel like we are beneficiaries of this current narrative war, and we can spot the right alpha on the ground here. Because, and in part, when folks think about China, not much is there in terms of how to think about investing in China, and rightfully so, because there isn't that much content coming out of China that isn't in English, right? And so there's, at a very minimum level, a low-hanging fruit that could be resolved, just a language barrier. But outside of that, it's understanding how Chinese culture works. It's understanding how the behaviors of consumers work. It's understanding how these tech companies are architected and have developed over time. And so we decided to launch CVA Funds with our first product, CGRO, the China Growth ETF, focused on spotting the next wave of Chinese alpha via themes that we are confident in that will drive China the next 10 years and beyond. So it's an actively traded fund, and we are actively managing a couple of themes that we like currently that you touched upon earlier, and super excited to go into a couple of those more in depth.
Let's dig in. So let's start off with the challenges, and then we'll get to the opportunity. So I'll summarize that briefly. Like everyone knows, China's got real demographic issues. The replacement rate is around 2.2. If you want to maintain steady population, it's dropped down to 1.1. That's one issue. We've also seen reshoring and nearshoring hurt demand for China products, and other countries have benefited from that. We saw in the last month or so, Chinese President Xi Jinping visit SF, and Ben from CVA Funds had a chance to shake his hand. So you definitely, you're in the front row there. And I read that as a capitulation. And of course, the president also made remarks that they want to avoid conflict and quote unquote spheres of influence and all the rest. The other backdrop surrounding all this, of course, is China has quickly ramped up EV production. It went from not at all active to a dominant global leader. We're seeing China investment in semiconductors outpace the United States in dollars and deal activity as well. So if you could walk us, Tim, summarize the challenges around the banking sector and the dynamics around how people save, and their primary form of saving is housing, and where that got us today.
Yeah, so there are a couple of questions and themes there, Ram, and I will pack them one by one. So the first is, sorry, Ram, can you hear me?
Yeah, you were cutting in and out for a moment.
Hey, can you hear me?
Yeah.
Sorry about that. Can you hear me now?
Yes, go ahead.
So there are a couple items you touched on in terms of topics, so I'll unpack them to our ability as best as possible. So the first item of demographics, yes, it is a real structural issue, and it's funny because what's happening is China stopped the one-child policy a couple years back, is now pushing for two-children policy. Actually, last year I think they started pushing for three, and you get this funky dynamic where in certain cities around the holidays, your mobile provider will send you a text poetically telling you about, the sun is bright, the nights are long, you should get into a couple of them and start having kids. Like, imagine if T-Mobile sent you that, right? Like, that doesn't happen, but it's imperative to understand how this fits within China context, which is the Chinese propaganda, or how they want to direct the top-down economy, comes through in this manner, right? I always joke that if they want to reboot the demographics, they just have to make it so that you must have 3 kids before you're qualified to buy a house, right? You'll start to see kids popping up left and right. But that's because at its fundamental level, housing has always been the stalwart, or the foundation of Chinese growth in the past 20, 30 years. But quickly before I jump into that, on demographics, one thing interesting to note is China does have this demographics issue. And I think it doesn't behoove us to think, to bet 10, 20-year trends in that sense, because tactically too many things are moving at one piece. But what's interesting about that is you have an over graduation or oversupply of college graduating students from China, right? And it's at a pace where I believe sometimes in the first tier cities like Beijing, Shanghai, they are making less money upon graduation than blue collar workers. There's just an imbalance in supply. And what that means is these technology companies doing R&D, deep tech, etc., can hire PhDs for much less than what they're getting in the US. Obviously, there might be a disparity between the quality and depth, but I think that's more around, China's advantage is being able to iterate and ship products out faster. So that's kind of our thinking on demographics. The challenge is there, but we see that the government is taking active measures to fix it, and it's a very long-term thing that, in between, there's still a lot of alpha opportunity.
Real quick, is there an actual and official 3-child policy? Like, what does that mean?
There's no official 3-child policy, but they are starting to push, guide softly for families to start having 2 children. This was a couple years back, and now pushing and softly guiding for 3, because they know it's a challenge.
Understood. Got it. So do you want to walk us through, the housing buildup that led to the recent crisis? I think the main takeaway is that people's primary form of savings was buying a house. If you want to get married in China,
Yes.
you have to have a house, or after you get married, you move into a house. And if you have extra savings, you go buy another house. Is that an accurate summary? That's the culture of savings in China.
Exactly. It's almost this joke where China's GDP growth is based on this Faustian bargain via housing investments, which really is, they were so strong on selling this propaganda of you must have a house before you can marry, right? And that really pushed the growth.
Powerful. That's a powerful cultural driver. If you want to get married, you have to have a house.
Exactly. So, I won't get into all the nitty gritty, because I think there's a lot of question marks out there, and it's hard to decipher. But what gives us comfort is that a couple points. First is that I believe recently in the news that PAG started striking a private deal around, I think it was Wanda. So, they reached an agreement around pre-IPO around rescuing them. so that they don't default on the $4 billion repayment. So that's one thing where it shows that
PAG,
private
and who's
market
Wanda?
forces are enacting.
Who are those
PAG
entities?
is a large private equity fund, I think based out of Hong Kong, but basically private market forces are coming in. I think in the last couple of economic forums and meetings, the central government has assuaged fears in the local government that they will intervene, but they haven't had to yet. And a lot of local governments are currently finding ways to refinance so that they can keep the housing situation under control. I think one thing to note here around housing is even though Chinese put a lot of their savings into housing, the barrier to buy houses in China is very different than the US. Whereas in the US, the standard is 10% down payment, sometimes even 5 if you were in a low interest rate environment. In China, historically, it's been 20%, sometimes even more. So these individuals have a lot more equity locked up in the housing. So, there's always an argument where if there is a crash, it won't be as bad because you don't have a bunch of rehypothecated debt that's rolling over each other. The challenge is more because imagine if like 30-40% of your, if not more, of your wealth and assets are locked up in housing, and housing prices for the past 30 years have only gone up. Suddenly it's flatlined, if not, come down a little bit. People get spooked. So the real challenge is until there is clear path forward on policy, property stabilization, consumer spending confidence is down. Now, consumers have saved a ton of money in the past couple of years relative to their counterparts in the U.S. Whereas, the U.S., the Fed were handing out stimmy checks. China was in complete draconian lockdown where people were not allowed to go anywhere. I myself was stuck there during that period, and there really wasn't much to do. I mean, you could say you could buy products online via these e-commerce companies, but you couldn't. There was no leisure. You weren't really going out because there were so many friction points that disallowed people from traveling. So, the way we see it is, yes, there is a challenge in the properties sector. It's anyone's guess how that will play out. But I think a lot of that fear has been priced in if you look at where a lot of non-Chinese internet names are trading relative to the S&P. And then, so where our stance is, okay, well, we expect to see some clarity come early next year. And that will set the stage for, you and I talked about, almost a second reopening of China where, once property is stabilized, consumer confidence comes back, spending comes through. Now, then the question is, where will the Chinese emerging middle class start spending? And that's where our baskets and themes are focused on.
Right. And just to frame it up, the average savings rate in China in prior years was around 30% as compared to the United States, where it's around 2%. It's been elevated to around 50% due to fear. So consumers have pulled back, and that's why the initial reopening didn't have much fanfare. And there's also been stimulus from China. Do you want to summarize some of the stimulus that's been underway?
There hasn't been that much stimulus relative to the US. China hasn't really enacted that major of monetary policies. But that's not to say they won't take a heavy hand, top-down approach if something hits the fan, right? So the way we see it is there's still a lot of pools of capital sitting in users' accounts that can be unlocked via incentives as opposed to government taking a top-down approach. So for example, if they once there's clear guidance on property, they could lower the down payment threshold for housing if they want to spur housing again. I believe there's a recent changes in how stocks in secondary market or stock market will be taxed. So they want to spur and really nurture the local capital markets. What we like is China's I think the second largest retail market for stock trading, and that generally gives a lot of liquidity to these options. That's one of the reasons why we like A shares, H shares beyond looking at just ADRs as well.
Right. And there was a package that was introduced, I believe a 2-year plan to boost light industry. And that includes consumer packaged goods, consumer durables, sport and leisure equipment, light industrial machinery. And that's a form of stimulus to industrial policy, which maybe that links to some of the investment themes that you're looking at. So,
Yeah, I think jumping in, there was a recent update or announcement from the Central Economic Work Conference out of China. I don't know if it was even published in English. I think some folks try to translate it, but there were notably three key words that the Chinese central government wanted to focus on. The first is innovation, which we know is happening, specifically in AI, biomanufacturing, deep tech, space, etc. So that's the first bucket. The second bucket is domestic consumption. They specifically keyed out the words smart homes, entertainment and tourism, sports events, and domestic brands. So there's this move towards spending on leisure as opposed to just commodities and apparel and these types of consumer durable goods. And then the third is around going international, right? So, and we'll get more into this. Some of the biggest, hottest names today are Shein and Temu, and I don't know how much, if the world knows, these are Chinese dominant brands that are taking over the world, because the supply chain is so vertically integrated.
right. So what you're seeing is a transformation from the China of yesteryear, which is focused on export economy and housing-driven investment, to a new China. So let's dig into some of the consumer trends. I just want to give a perspective to our audience on the dynamism around China and where China is ahead of the US, both in terms of cashless society as well as e-com. So where should we start, Tim?
Yeah, I think, let me talk about three things. One is maybe
Yeah.
high level, the birth of this cashless society and what are the factors led to it. Second,
Yes.
why China is so digitally native at the millennial level versus in the US is, Gen Z. And the third, how that's promulgated into these tycoons of industry and these really strong companies that are dominating the world and where we think that's headed. So taking a step back, if you haven't been to China, highly recommended. One of the safest places in the world, easy to get around, super hyper convenient. It starts with Alipay, which is the payment tool for Alibaba's Taobao, which is the eBay competitor in the early 2000s, as well as WeChat, which is the ubiquitous messenger, which dominates 99% of all messaging. Now, Alipay started as an escrow service, and you're allowed to digitally pay via your phone to buy goods. Think of it as like Apple Pay today, but this was maybe 15 years, 10, 15 years ahead of Apple Pay. And Apple Pay only recently got widespread adoption in the US after COVID, right? We started moving a little less away from credit cards. And the second is WeChat. Now, WeChat was looking at Alipay and thinking, that's nice. That's a nice chunk of transaction volume you're doing. Maybe we can do something like that. So in Chinese culture, at New Year's, you always give a hongbao, which is a red envelope, which usually consumes of some cash to your friends and family. So WeChat decided to digitize that. And almost overnight, volume spiked, taking away from Alipay as well as the local banks because people were withdrawing from the local bank, topping up their wallets in WeChat and sending this money. And soon enough, WeChat came to parity with Alipay, around 50-50 market share around how money is moved. And then they started going downstream to merchants, and merchants' acceptance no longer went from cash and they skipped credit cards straight into accepting WeChat and Alipay. So if you ever do get the chance to go to China, you realize every merchant accepts WeChat and Alipay as a form of payment. All you need to do is scan a QR code. So what that's done is it's turned Chinese into a very frictionless society in terms of payments. Imagine if you want to buy anything, it's a one-click payment, right? That's the power of what's going on in China. Now, what happened after this? What happened is you take a step back and you think about how China has been architected. It's top-down command economy. A lot of the cities look the same, right? Whereas if you've ever been to London, it's like a mixed mash of roads because it's the evolution of thousands of years of roads. In China, Beijing is circular. There's ring road, second ring road, third ring road, fourth ring road, so on and so forth for other cities. And the planning for neighborhoods, you get these large apartment buildings, 3 or 4 or 5 all in one block, and there's probably 5,000 to 10,000 people living in one. So what that means is you've created this offline grid of hyper efficiency if you want to make deliveries. And this led to the rise of why e-commerce was so popular in China, because the cost of a delivery was something, I want to say less than 10 cents US, because you have one delivery driver who can go to an apartment block and just do that couple thousand deliveries on a daily basis, right? Unlike the US, you have to go to each neighborhood. Now, how does this matter to how China evolved and where it's going, where it had gone and where it's going in the future? Now, the last 10 years, the big drivers were the internet companies, right? Alibaba, Tencent, JD, and these mattered because for the Chinese, a lot of people mistaken because we take I'm myself American, take a Western mindset of how consumer behavior are and try to juxtapose it to this new emerging market, right? But that's not how it works. In China, digital shopping, Alibaba e-commerce is the whole e-commerce experience. There were no offline brand names that moved online. Alibaba was the first digital mall experience, and if you ever open up Taobao app, it's a mix match. Like to any Western user, it's completely nonsensical. But the Chinese are trained to that. That's to say, the Alibaba ecosystem is the e-commerce experience, how it started. If you want services such as hooking both hotels, tickets, food delivery, that is the Meituan ecosystem for all services, right? And so what that means is people in China don't Google. There's no front page of the internet where you Google for what you look for. They jump straight into Alibaba for shopping or these specific apps, Meituan for food delivery, WeChat for messaging. It's almost like today, which is what it feels like the US is going to, you don't really use Google anymore. If you want to shop, you jump straight into Amazon. If you want social content, you jump straight into Instagram. If you want delivery, you go straight to DoorDash or Uber Eats. That's where most of people live today. And that was the driver the last 10 years. But we think that's topped out in terms of consumer behavior, innovation, and where government policies are steering.
Let me play that back.
10 years.
Let me play that back. Let me pause and play that back. There's a lot there. So first off, there was a cultural digital money concept that originated with red envelopes that started with physical and then it moved to the digital, starting with WeChat, which is owned by Tencent. That was one. And then second, it's how people lived in dense areas that enabled delivery efficiently. So that enabled the rapid growth of e-commerce. That was number two. Then the third, people shop online as their primary mode of experience as compared to shopping malls in the United States. So when people go online, I'm just sharing this website here now, and maybe if you could just walk us through this, Tim.
Yes.
What we're looking at here and how to interpret this. Here we go. This is Shein.
Yeah, so Shein is the next generation of e-commerce. So for those of you, you're probably very familiar with it. They were doing a ton of ads in the US past couple of months, and you're likely to see them more and more. If you have kids who are Gen Z, it's very likely they shop from here. Many don't know it's a Chinese company. The way to think about Shein is that it is a Zara 2.0, a Zara online. Now, what Zara did well is fast fashion, but more importantly, their supply chains anywhere, I think, around 21 days for them to design a new idea. They have designers, and then they automatically put that in store. So their inventory is always changing. Shein one-ups that. They can do it in 7 to 10 days. And I don't mean 7 to 10 days from ideation, some designer sitting in a back room, to manufacturing. They have tight relationships with the factories. What they're doing is the page that Ram sees right now is highly curated and pushed just for him. It is like TikTok. They have algorithms that push what is best selling, and they know they're tracking every movement you make, what you buy, what you like, so they can start pushing you more products. And then as a whole, they can read into that data and say, oh, there's a trend towards buying pet toys, a trend towards buying plaid shirts. And automatically, algorithmically, that goes back to the factories, which they are very tight with. They have teams sitting in the factories themselves to iterate on, okay, what's the best selling product? Let's ship it. And then within 7 days, that will probably launch on the store, get pushed to you. And then if you order it, it comes in mail, however long shipping takes. So
they're vertically
next
integrated.
Generation. Yes.
Right.
Very
Again,
much
to play
so.
that back. So Zara pioneered fast casual, and the idea behind fast casual was that fashion comes and goes quickly. There's a zeitgeist of the moment. If you're on trend and on fashion, you can clear out your product. But if you're off trend, then you accumulate inventory. No retailer wants to do that. So what Zara did is develop this idea of fast casual where they could identify a new trend and then rapidly manufacture against that. And you described that, I think, 21-day cycle time. And here we have Shein that's compressed that dramatically because they have vertical integration down into the supply chain. Now, they don't control the logistics, the delivery side of that, right? That would go through like a Baba, presumably, or?
So Shein only does overseas. They don't compete in China.
They only do overseas. Gotcha. Right. And
Yes.
Shein is an IPO, I believe, that's going to come to market at some point.
Yeah, there's going to come to market soon. So that's one we're keeping an eye on.
Gotcha. Okay, great. So what are some of the other, differences in consumer behavior between China and the typical US consumer?
Yeah, I think one thing you and I touched upon is this concept of brands, right? In in the U.S., the American consumer psyche is pretty mature. Maybe not as mature as you know Scandinavians who are all into recyclable fashion. Not there yet, but it's mature in the sense a lot of baby boomers, Gen Xers grew up with Sears and Roebuck, so that this whole catalog experience then became the physical shopping mall, right? I don't know if anybody still remembers Kohl's. I don't know if they're still around, right? And then all of that.
From here, but
Okay, that moved into like mom and pop stores, Walmart, and first you digitized upstream these big superstores, right? And then all the small ones, because people got tired of shopping in a superstore at Kohl's, they want individual brands with identity, right? It's the individualism concept as we Americans have. So they want to support small businesses, and then Shopify came around and enabled them to go online. So that thinking of the US is you can shop mass market online, but you want to hunt for the next D2C brand, direct to consumer brand that might be advertising on Instagram in this one specific niche because you align with their vision, their branding, etc. That's the American psyche. Now, when you look at China, they're still very early on that curve. I would say a couple years ago was the peak of them still, loving all the mainstream fashion brands like Gucci products, etc., just recognizing name brands. Now, what's interesting here is where's that going in the future? There's two main themes I want to highlight. The first is this concept of 国货, which means nationalized product or domestic products. There's a strong penchant towards buying domestically produced products. Now, why is that? Two reasons. One, sure, there's a bit of nationalism, but the more important thing is China literally sits on top of the supply chain for apparel. I mean, when I was there, you see something that's avant-garde off of Fashion Week, that gets imitated and it's on a Taobao store the next day and you can buy it and it comes to you in 2 days. So the iteration speed on how they're cranking out fast fashion, street fashion, etc., is unparalleled. If you go to one of these tier one cities in the hotspot, I mean, you see young people dressed like they're walking in Fashion Week. It's stuff that you wouldn't necessarily see in the US yet because there's not that lag time. But what that does is it's hard to carve out and build brand equity because at the lower level, because you can align with someone's design, but there's another 1,000 copycats who's trying to undercut your price. So it's very hard. Generally, how brands grow is a lot through influencer-led marketing, and they build it around that, right? Hence, there's two interesting names. One is Li Ning. It's named after a famous Chinese sports athlete, and then there's Anta. So these are two very strong local sports brands that have done very well. And if you think about, okay, so what's the bigger at play here? Who's getting squeezed out? It's the Adidas and Nike. Chinese consumers are no longer, they still want to pay for luxury, right? Which so like Arc'teryx.
Louis Vuitton has still got a big, bid in China. Nike
is still there
too, but year-over-year sales are slowing from those brands.
Yep. Luxury like Arc'teryx and Lululemon, and then very bottom cheap stuff, which has no brands, will still be around. But the guys in the middle, Nike and Adidas, that will lose out to the Chinese domestic brands. Funnily enough, Arc'teryx is actually owned by Anta. I don't know if people know this, right? So it's what we're seeing is the shift towards domestic brands. That's the first
Wait, are Li
general
and
statement.
Anta publicly traded?
Yes.
Interesting. All right, we'll come back to that. And so the drive for Chinese brands, that's not coming from policy, that's coming from a China consumer taste, or both, or how to think about that?
There's no official policy pushing for it. Sorry, I call it Guohuo. It's called Guochao. Guo as in country and Chao as in trendy. So there's no official government policy. It's the result of we felt a very stark sentiment shift in 2019 when the whole trade war started, where Chinese became much more nationalistic, and then you couple that with just the cheap price of goods. As we mentioned, the cost of delivery is so cheap, it's easy to buy. They're iterating products left and right. So it's a mix of those two things that have given rise to this thing called Guochao. And the funny thing is, the government actually officially called it out in this economic forum as a key trend to watch, right? They want to spur domestic spending on domestic brand. And China is still shedding that made in China pejorative term around cheap goods. But if you look at, the products you're buying from China, the quality is similar to what you're getting in the US at a mid to high level, $100, $200 sweater, etc. But you're getting it for 1/5, 1/10 the price. So it's catching up quite a bit, right? Then it's just a function of how well do you do the branding. And here's a funny story for you. If you look at Amazon, 50, 60% of merchants, if you buy any good whatsoever, it's commodities or, paraphernalia, jackets, etc., chances are that's a Chinese company in the background. You can tell based on if the company name is a random mix match of letters, that's generally a Chinese company. And if you start getting Instagram advertisements, or if your children are around niche direct-to-consumer apparel brands, chances are it's also Chinese. Why? Because the children of the manufacturer and factory owners are generally have been educated in the West, and they come back and they say, hey, why don't I just extend my family business and start selling direct to consumers in the US?
So this is a powerful new trend, and it goes back to the earlier point, which is that Gen Z in China doesn't go to websites. Like, for the audience, you got to listen and tune in on that point. What people are doing is going to social media and then shopping first with social media. I know that I think I've made a handful of e-com transactions. I got marketed over the last 2. I've been getting spammed with e-com, and I think a few years ago I got the device where it's like the gong in your hand, it makes a different tone.
Yeah.
I've got all sorts of little things that over the last few years, COVID moves it. But that's a key thing. Like, the platform is now social media, not just for content, but for e-commerce. And that's also explained the rise of PDD. Do you want to explain who PDD is and how they've captured a lot of focus as compared to Alibaba?
Yeah, absolutely. One more quick note is one of
Yeah.
the biggest sales days in China is 11/11, November 11th, because it's 1111. It's called Singles Day, right? It's the anti-Valentine's Day. And Amazon Prime Day, also is around then. Alibaba Singles Day generally does more than twice the volume of Amazon Prime on a sales volume basis. And one of the markers to look at is who are the top selling phones, top selling brands, etc. And for the first time on cosmetics, it's no longer the likes of L'Oreal or Estee Lauder. It's a domestic brand called Proya Cosmetics, who's also publicly traded, I think, in the either A share or H share. So those are like leading indicators telling us that the taste starts shifting, right? And we're actively investing in these new trend of where the tastes are going. Now, why does this matter for Pinduoduo? Pinduoduo, the story of Pinduoduo is when Alibaba got their act together in the initial days, there were a lot of cheap goods, not fraudulent, but really poorly made stuff, sometimes counterfeit. That all got washed out when they went public. They had to tighten up their quality assurance. Pinduoduo came in and filled the vacuum. They took all these goods, sold it in mass, so bulk selling, almost like Costco, but they gamified it. So, Ram, if I wanted to buy, God knows why, 20 rolls of toilet paper, I could buy for, let's say, $2. But if I invite you and you also add to cart and pay in the next 5 minutes, we get a further 10% discount. Now, why did this work? Why did this catch fire? Because I could share the link instantly through WeChat and it's a one-click checkout. Plus, the cost of shipping that to my house is so cheap, it's de minimis, right? People don't care because shipping cost is so low. And they focus on second and third tier cities. So these were even the emerging of the emerging middle class that were, that couldn't actively buy from Taobao. So it's a mix of sitting on top of the existing frictionless payments and logistics layer, and then coming in with these gamified versions. And now we see that today. If you're on Shein, chances are you have a gamification like, oh, spend this much, get in this tier, spin some lucky wheel. Those things have been gamified, tried and true in China to work 9 times out of 10. Now, Pinduoduo has done really well in China, and they are now kind of the darling, and they're growing quickly, mainly because they saw the rise of Shein. It came out with a product in the last year or so called Temu, T-E-M-U. That's also targeting Westerners, namely Europe and the US. The differentiator is a bit kind of the target demographic and products they're selling. One of the stats I like to quote is if you look at how Meta did this last quarter and why they did so well in terms of ad sales, a lot of that came from ad buys from Meta and Pinduoduo and Shein. So what Pinduoduo is doing is tapping into also this zeitgeist, this new trend from China, which is selling abroad, going abroad, and really dominating that channel at the e-commerce level. Now, it's only one of the verticals where China is taking over the world. And if you didn't know that Shein or Temu is Chinese, that's part of the playbook. They don't want to come off as Chinese. They want to come off as Western as possible.
Fascinating. So let me play that back. So one of the major drivers of Meta's ad revenue growth, and I believe Meta's ad revenue is something like $30 billion when I last looked, significant and growing quickly, is from China e-com companies that are marketing through Meta, Facebook, social media to go sell products. And the stock price I just showed there is PDD. I'm going to share my screen again so you can see it. This is a stock that's gone up over 50% while China has this bear market, right? So, underneath the surface, there are these opportunities and these emerging market leaders. This is PDD, which Tim was talking about. It's nearly 200 billion market cap, a forward PE of 24. And a 3-month return of about 50%, and a 1-year return of about 65%. I think another one that's interesting to look at from what's happened is Luckin brands, Luckin Coffee. So Luckin is a funny story because weren't they accused of fraud, and yet here they are at all-time highs? And what's going on with Luckin Coffee?
Yeah, Luckin is another funny one. Q3, they had more sales and more stores, and I believe sales volume than Starbucks in China. Most people have never heard of Luckin. Only if you've been to China, you will have heard of it.
But Luckin came in and filled it's Dunkin' Donuts in China. It's your story of China consumers want a local brand.
Yes.
They don't want to spend money on Starbucks or Dunkin' Donuts, and Luckin Coffee is the local brand, and it's been growing like a weed. Go for it.
Yes, and I want to double click there a bit and come back to difference between consumer behavior. Starbucks, why is there a Starbucks sometimes in big cities across the street from one another? Because there's too much traffic volume. But the only way they build a relationship with the customer is for you to come into the store, right? And eventually they moved past couple of years to like a digital app and the whole thing around them running a bank on cash gift cards. But Luckin from day one is delivery and pickup only. You cannot physically walk up to a store and order at the counter. There's no one going to take an order. It's almost like a Caribou coffee. It's a small kiosk, about maybe 5 by 5 meters wide, and there are 2 baristas working on orders. That's it. Why is this important? To order, you have to download their app, and you have to top up and spend. When you top up, they capture your cash flow, so they can have it sooner before you can spend it, creating a negative working cash cycle for them, which is great. Second, they know your habits. They can push notifications to you, tell you, hey, you last ordered a coffee at 2 p.m. on Monday. You want to order again? and they have so much data on you, they can start pushing discounts. It is purely digitally native. Now, what happened in Luckin? Yes, there was some accounting fraud and they got delisted, but the fundamentals haven't changed, right? I think this is a stock that went from low single digits to $30 in the past. It's like a retail favorite if you go on
Is it a retail
Twitter,
Momo stock,
FinTwit.
or and
What's
was it?
that?
It's a retail. Is it a retail Momo stock? Momentum stock?
It's actually, if you look at likes of Wall Street Bets or StockTwits or FinTwit, it's a retail favorite. They like these stocks because they think it's underpriced. There's a cult following behind them, similar to NIO, which is another electric vehicle brand. So there are a couple underappreciated gems in China that are fundamentally doing well, but we don't get those reports in the US because you're not physically there, or nobody's covering them. And it's part of it's also the Chinese are horrible at telling an international story. If you ever been on a quarterly earnings call,
Well, that's quite an interesting
really
point.
boring.
You're right, because American management's really good at storytelling. It's how do you package and tell a simple story that people can understand. Google says we organize the world's information and don't be evil. And I think one of the points you're making, one of the themes that's coming out here is China can ship product. China has data and analytics. China can manufacture. China's manufacturing a significant amount of the world's electrical vehicles and shipping that to the Middle East and Europe right now. Tesla's manufactured in China, but China hasn't solved the storytelling, and China brands are still coming into maturation, and China consumers and the maturity of the China consumer in terms of how they relate to brands is coming to maturation. Is that a fair statement? Or
Yes. So the way to think about it is there are a couple of verticals that are extremely strong that China is extremely good at. One is anything e-commerce related, right? And then you have like electric vehicles. And what happens is the fundamentals of these look really good, coupled with once you get stabilization in property policy, that will unlock consumer confidence to spend again. That will increase the top line, et cetera, of these companies. Now, the rest of the world on the top side, there's a lot of FUD and negativity narratives that's depressed pricing, that's priced in. So we're coming in and we want to buy these now, when they're cheap but fundamentals look good. And you're just waiting for the flip to switch around. Can they tell a better narrative? Can they, can Western investors better understand these products? And once that happens, just like I think with PDD, we're going to get some tremendous amount of growth.
Right. What you're saying is once the cloud's clear, then people will recognize the value, and then those opportunities will get bid up. Let's talk about electric vehicles. Do you want to summarize that market and China's role in that market, where it's been, where it's going?
Yeah. A couple of key things to note. One is China historically has done a really poor job of creating autos in the traditional sense, like gas guzzling. And it wasn't only until, I want to say, maybe 10 years ago, government started pushing out very aggressive subsidies on electric vehicles. And one of the reasons is because China has a stronghold around lithium rare earth batteries, and the manufacturing capability is top notch. It's insane. Now, before they were beholden to the German ingenuity around creating a motor engine, but hey, with the rise of ESG, et cetera, towards electric vehicles, you don't need that anymore, right? It's all electric. So China also is vertically integrated. Now, what you see here is a company called Zeekr. I mean, this thing looks like a Porsche Cayenne, and these are cranked off the conveyor belt so quickly in China. It's insane. I was back last summer, and I was thinking to myself, walking through a mall, I saw 5 or 6 different brands just like this. I thought it was a show car, but no, you can scan a QR code and buy it right away. That's the level of
another consumer trend. So you're in the mall, you
Yes.
scan a QR code, and you buy it via your phone. You're not giving a credit card. How is it? What's the form of payment on that?
Yeah, so there are installments you could do, and that's natively embedded within Alipay or WeChat. Credit cards are not really a thing.
So it's all
Um,
managed via Alipay and WeChat. So WeChat, of course, is similar to like Facebook. It's a social media app in China, and Alipay, of course, is like, I would say, like PayPal. Of course, Alipay is a
yes,
subsidiary of Ant Financial, which is owned by Alibaba.
yes. Now, what's important here is, I felt like I was in what have been felt like the 1950s in the US, where, you had Pontiac, Saturn, a bunch of these interesting brands being rolled out. And in China, these are almost a dime a dozen, and they are coming to market so fast. The Chinese population, I want to say 20 electric vehicles is almost close to 20% of car sales. So it's incredible just how quickly they've pushed it into the market. And not only pushed it, they're building a lot of charging stations. One other thing to note is, if you look at Tesla, I want to say one of the quarters earlier this year, 20% of revenues came from China, right? Could they have cranked out so many Teslas if they didn't have the Shanghai factory? Probably not. And one of the trends in some of the companies we're looking at are the suppliers who are supplying the goods into electric vehicles, such as Tesla. So we've seen one company start with AC, and they're moving into glass, and they're taking a larger share of wallet. So, for example, if Tesla costs 30,000, the car parts, they maybe started with 10%, and then now they own 20, 30%. And that's growing. And that's a trend that we like a lot as well. Here's another one. This is in the Middle East, they call it the, a cheaper version of a Rolls Royce. This thing looks very impressive, and it's much cheaper. So we're starting to see China just crank out these beautifully made cars. And if you ever sat in like a Tesla, it feels very, what's the right word? Sterile, right? There's not a whole lot of bells and whistles. If you sit
Like
in
a
one
toy.
of these,
It's like a thing in a toy, I think.
yeah, if you sit in one of these, it is luxury. I mean, they have top of line amenities, whether it's like super nice luxury chairs. They have little TVs on the passenger seat you can lay down. It's next level. And because of China's strength on the manufacturing side, these types of companies are possible. And now they're mass producing and shipping these globally.
Why don't we see these in the United States? Is that a consequence of tariffs or something else?
Great question. I'll have to dig into that a bit more and get back to you. It's possible, but also one of the things Chinese doing is they want to be cautious about how they roll these things out. So there are certain markets that are moving outbound first, and Chinese have always been, let's dominate the local market before we go overseas. So they don't think the local market has been saturated yet. It's only now starting to get a bit more competitive.
Got it. Makes sense. But they are selling those luxury EV products in Europe and the Middle East today.
Yeah, you could also buy a NIO in the US. They have offices there. NIO, it's a publicly traded company. It's more on the luxury end of electric vehicles, top upper tier.
Got it. And just to kind of recap on the brand side, so is your thesis that the brands that are caught in the middle of the luxury ladder are the ones that get squeezed out? You mentioned Nike, but what about the high-end brands like Hermes? Does Hermes hang in there? Hermes is probably the highest of the highest, right? Louis Vuitton, I'd say it's a couple notches below that. Ferragamo
Yeah,
somewhere between. But how do you see the brand landscape playing
luxury
out?
brands are still going to do well.
People want
Simple.
status, and they want a global currency of status, and that is
Yes.
brands. Is that a fair way to look at it? Okay.
Just go to your local airport's duty shop store next time you're there, right? How many of the people at Hermes are actually Chinese sales associates that speak Chinese, and how many shops are Chinese, right? That will always persist.
Got it. Okay, great. Well, let's talk about your ETF product. So I think when most people think about investing in China, they think about the KWEB ETF. And that ETF, your thesis, that's imperfect, and there's a better way to do it. Do you want to introduce that story?
Yeah, I think KWEB has done phenomenal and has offered a great opportunity to access China in the last 10-ish years that they've been around, if not a bit more. But because it's a passive fund and it tracks the CSI index, which only certain companies go in there, they missed a lot of companies. So, for example, that index does not include the likes of Taiwan Semiconductor, does not include the likes of BYD, which was a Berkshire Hathaway favorite. It's an electric car company. we feel like they might not be able to move as quickly to capture the next trends that are coming, which are the themes that we've identified around consumer domestic spending, electric vehicles, automobile or other parts as part of that supply chain. So we want to take an active step on saying, okay, well, because we have this robust network and strength and experience being on the ground here in China, have lived through it, and know how the winds are blowing both technologically, innovation-wise, as well as geopolitically, we feel like we are probably at the forefront of understanding where these trends are coming into play, and we want to be ahead of those trends and offer that as a product to the market.
Got it. And the ticker of your new ETF is CGRO?
Correct.
Okay, great. So let's walk through some of the holdings there. I know this is a very new ETF, so there's de minimis performance history on this, but we can at least look at some of the top holdings. What would you want to call out there?
Yeah, so we only recently launched. I think maybe a couple names that stand out I want to share about. One is of Alibaba. This is an interesting one. I agree with you. Fundamentally, it still looks rather cheap and priced well. I think it's trading at, if not a little below where it IPO'd many years ago.
Kind of amazing.
And yet,
Yeah.
and yet, I mean, they dominate a strong facet of every Chinese person's lives. Another thing, I think a lot of the negativity is priced in around they wanted to split into different subsidiaries and list separately. And one of the things that I think Westerners miss is they dominate on the logistics side. They on the similarity of like fulfilled by Amazon, they have similar products, and that's
So they're like
very
third
strong.
party. They're like the third party shopper experience, the third party brand fulfillment experience for Amazon. That's the analogy to Baba.
I think Amazon's the closest analogy.
Correct. No, sorry, that's right. The Amazon third party fulfillment
Yes.
experience where brands can go there and set up shop and then tap Amazon's fulfillment infrastructure. That's the analogy to Baba.
Yes, and I think Baba is one of these where I think PDD has taken the limelight, but if we think about China reopening again and narrative becoming more friendly to China on certain respects, and we start seeing institutional fund flows moving in, I think a lot of it will go to familiar names, right? People think Tencent and Baba are just proxies for the Chinese economy. And so that's one of the themes that we're playing. But broadly, we also have the likes of PDD as an e-commerce play as well. We have a couple electric vehicle names. So those are kind of the themes that we're actively investing in.
Got it. And then what's your thesis around Tencent? That's your top holding.
I think Tencent is just one of these stalwarts, right? Where again, it's just a proxy to China. Tencent is permeating through every facet of Chinese life, whether it's through WeChat, Pay, insurance products, buy now, pay later, credit. If you look at credit in China, I think on a per capita basis, on a per individual, it's like less than half compared to the US. So average Chinese consumer doesn't use that much credit and saves a lot more. So if we think about the ability to unlock that spending power, these companies will ultimately benefit. There's another name that we think is underpriced, and it comes back to this, a narrative is all it takes to move the needle, is Baidu. So they've, I think, very well underperformed expectations historically. But if you look at what they are now, they're positioning within AI, and their chatbot is about, I think, maybe half the size or something like that of OpenAI's ChatGPT. They turn on subscriptions, but I think the market cap of Baidu is $40 billion
40 billion and a 10.6 forward PE ratio.
Yeah, versus ChatGPT, which is an $80 billion private company. Now that's only one of the things they have. They also have electric vehicles, autonomous driving. They are doing 5 times more driverless rides than I think Cruise, or maybe it was Waymo, on a quarterly basis. So, but that story isn't well told because again, Chinese companies are not great at telling a story internationally, right? And if we look at how Baidu has moved historically, it's really about the rise in price really around, can they do a good job of selling a narrative? So we like what we see, what's boiling underneath in terms of the fundamentals, and this is one I think should be interesting to watch for.
Right. Part of the overhang on these large three Chinese companies is that their year-over-year revenue growth has stalled out, right? So 2022, it was flat. This year, it's about
Yeah.
7%, and they came down from strong growth rate. So it goes back to where we started the conversation around, when do you see stabilization in the housing sector that allows consumers then to relax, save less, and then start spending more? And the idea is that these are the brands that would benefit.
Yeah. And one more name I want to highlight. It's a new company that we started getting into, which is really fascinating. I forget the ticker. It's listed in A-share in China, so it's tough for retail to get direct access. But it's called China Online, kind of a play off American Online. And these guys recently became very popular because they launched an app called Reel Short, REEL Short. And what's interesting here is they took the new digital consumption format of Reels, so like vertically facing mobile content in 1 to 2 minute segments, and they created these sappy rom-com storylines, almost like if you're at a supermarket, you're at a checkout line, one of those rom-com novels. They've turned that into these. It's incredible. I mean, these guys are getting millions of views per show, and the themes are a little cringy to me, but this stuff is working. They had more downloads in the App Store in November than TikTok, right?
Wow.
So
we've got Reel Short on the screen right now. It looks pretty slick. It's kind of like a Netflix-like content browsing experience, and it's definitely targeted to a Western audience. This is a company in China, is that right? And these are this is mind-blowing. So
the
these
storylines are these like stereotypical Chinese storylines about a stepmother and wealthy elites, whatever, but they've localized all that to the West, and they were able to get all these actors because the strike that was happening. It's fun
well, that sounds like soap operas.
You
just described wealthy elites and stepmothers and family conflict and business dynasty. So this company is in China, and they hire Western actors in China, or are they using AI?
No, this is I think they have a studio in LA. This is all done in the US. And what's interesting here is this is another vertical where you're saying, wait a second, TikTok's parent company ByteDance isn't public yet for myriad of reasons. Of course, they have a competitor called Kuaishou in China, which we have a position in. But this is another, has gotten Chinese content companies awake now, saying, "Oh wow, you can get success pushing this type of content to America." Every company making up these episodes. You'll see a lot more flood of these companies coming into the market soon in the US, because they almost unlocked another vertical, just like they did with e-commerce.
Why that's a big deal is that America's been the leader in exporting culture. Michael Jackson, Doritos, Coca-Cola, from the 80s, Britney Spears in the late 90s. Now it's Taylor Swift. This is the other way around. This is China exporting culture to the United States. But it's with a twist, though. The culture, these are not heroes from China, like when we have legendary basketball stars from China and United States. That's a bit different. This is understanding American taste through analytics, through A/B testing, and then delivering it back to Americans like a mirror. Really interesting. I can download this on my phone, my app store, and I subscribe to these serial episodic TV shows. That's okay.
The episodes are snackable content. They're 1 to 2 each. They're like YouTube Reels. It's 1 to 2 minutes, and you view it on your phone, right? So you're like scrolling. So they figured out the form factor that people like doing this now because Instagram and YouTube Reels trained people.
Interesting.
So Chinese are really good at going after how behavior has changed, iterating on the form factor and shipping content. And it's very likely if you start clicking around, they'll reorganize, the for you and figure out what they should push to you. And they learned that from TikTok, right? Algorithmically suggested content.
Right. Let's check out one of these real quick. The reborn wife's project.
I poisoned you. Your baby died because of me. Oh.
We're not the
I saw
demographic,
our
Rom.
future together. We have a second chance.
If you don't divorce my brother, can we ever be together?
You might be surprised what I can do.
This time, I'm going to give him a taste of his own medicine.
So, is this just to get back at him for not being with you?
This is all your fault.
All right, got it. Yeah, these are modern
So-
soap operas, basically.
Yeah.
So, and is that company publicly traded?
In China.
In China. Gotcha. Okay, great. Well, what else would you like to share? No, I think we learned a ton. I think there's a few headlines. One is, China's a non-consensus market. There's been a lot in the news around conflicts between China and Taiwan and China and the United States. I kind of view recent events as a rapprochement. There's certainly unique diversification in China. There's value in China. There are legitimate questions, I believe, around population growth and the consumer spend economy locally. But the manufacturing capacity is there. The capability is there. We've seen that. What are some of the other conclusions that you'd like to share with us before we wrap up?
Yeah, I think the biggest thing to think about China is that for any investor thinking about getting uncorrelated returns to the S&P, I think China is probably the best alternative and historically has been. Now, again, because China doesn't do a great job of telling that narrative around what's next trend growths, what are some companies coming to market, it's hard for Western investors to tap into that unless they're really initiated or they've been on the ground here. But that's where we come in, right? We understand where the innovation is moving towards. We understand which companies are benefiting from which large thematic trends that are playing out in the next 2, 3 to 5 years. And so we think those trends are fundamentally different than the last 10 years, which is really heavily internet-led. And why we know this is because the government tells you, right? China is a very top-down driven economy. They have 5-year plans. They'll tell you what's coming into focus. And now the focus is deep tech innovation. So anything that's electric vehicles, AI, commercial aerospace, digital economy. Second is domestic consumption, right? Leisure activities, domestic brands, travel, smart homes. And the third is going international. So we are playing into those themes and picking the category leaders who we think will stand to benefit and drive the most upside returns in the next couple of years.
What do you say to investors that are concerned about fraud in China? How do you avoid that?
That's a great question. I think, those are ones that you don't know until you know. It's much more rampant for smaller companies. We focus on, larger cap ones north of generally 3 billion market cap USD. So these are, relatively safer. We're not, we can't say that all of these guys aren't, at risk, but I think the way to think about it is risk reward upside relative to where they're trading at now. There are some companies coming to market and, you leave that to us to do the active on the ground diligence to make sure we're staying ahead of any, wins on risk that are coming down the pipeline for these companies.
All right, terrific. Well, we'll leave it there. Thank you, Tim, so much for joining us. Really enjoyed this. Have a good one. Take care now.
Yeah, absolutely. Thanks, Ron.